Hi, I'm Mike Bernick from Money and Markets. We're in the midst of earnings reporting season as corporate profit reports will be coming in fast and furious over the next few weeks. But the trend in earnings expectations, it's looking pretty bearish right now. In fact, profit estimates for the companies in the S&P 500 have been cut by 8% over the last 3 months alone. So joining me today to break down all these numbers in more detail on MAM Extra, Weiss research analyst Mandeep Rai, editor of Top Stocks Under $10. Hi Mandeep, thanks for joining us.
Hi Mike, it's a pleasure to be here.
So let's set it up for our audience. S&P 500 profits are expected to fall about 5% year over year according to current estimates. And that's definitely a downtrend from what we've seen in recent quarters. So do you expect falling profits to perhaps pressure stocks, or is the bar already set low enough that we could see some positive surprises?
Thanks, Mike. Yeah, to tell you the truth, I am a little bit more cautious this season. As you just mentioned, first quarter earnings is expected to decline by 5%. In the quarter prior, fourth quarter, we saw 5% earnings growth. And the quarter prior to that, third quarter last year, we saw 11% growth.
Definitely heading in the wrong direction then.
Exactly,
Yeah.
and that's making me a little bit more cautious. So basically, if you have earnings declining, you're actually paying higher for $1 of earnings of the S&P sector. The S&P sector is just a function of the earnings of the companies that are in that sector.
Sure. How about energy stocks? That's a real drag on earnings this quarter. Energy sector stocks are supposed to be down 60% in terms of earnings growth year over year. Is that really masking, making things look worse than they actually are for the overall index?
It's a terrible headwind to face for the S&P sector because the energy sector in general is about 8 to 9% of the S&P 500. So if you have a 60 to 65% correction in earnings in that sector, that's going to be a significant.
It's going to have an impact, yeah.
Exactly.
And how about the strong dollar? 70% of all S&P 500 companies are specifically citing strength in the dollar as the reason for disappointing results. Explain for our audience why a stronger dollar is bad for corporate profits for these S&P companies.
Sure, Mike. So we saw a rally in the dollar versus its currency peers since July, August of last year. We're up about 20–25% versus those peers. So effectively, for companies that are producing in U.S. dollars and shipping those goods abroad, you're that good in that foreign currency has become 20–25% more expensive. So if you're a customer in those countries and you're looking at substitution with a cheaper domestic good, you're obviously going to choose the cheaper good. So that's a headwind for U.S. companies.
All right, so U.S. Companies are getting priced out of some of these markets in Europe and in Japan, where the dollar is much stronger than it was a year ago.
That's exactly right.
All right, let's talk about the silver lining this earnings season. Which sectors or specific stocks are you finding good opportunities in right now? Companies that can exceed earnings estimates, perhaps.
Sure, that's a good point to make as well. I like the small cap stocks. And the reason why I like the small cap stocks is because they're relatively more insulated from the global impacts of currencies. Small cap companies are regionally located. They produce their goods here in the U.S. in the same currency that they actually sell those goods. So they have a negligible effect of from the U.S. dollar appreciation we've seen.
All right, we'll be keeping a watchful eye on earnings results in the weeks ahead as a key catalyst for where markets may be headed next. Thanks, Mandeep. I appreciate it.
It was a pleasure. Thanks, Mike.
You bet. And that's the latest word on earnings expectations from Mandeep Rai, editor of Top Stocks Under $10. Thanks again, Mandeep. And thanks for all of you for joining us today on Money and Markets Extra. I'm Mike Bernick. Good investing.